There's a well-known concept in startup world called survivor bias, where the only thing that you read about are the huge successes, and nobody really wants to talk or read about the failures. And so those tend to go unnoticed. The way it looks to somebody who's not really paying attention is that building a startup must be easy, a great way of life. You end up with sports cars and super yachts, and so I'm pretty smart. If they can do it, then surely I can as well. When the reality is quite different. And if you talk to a venture capital investor, they'll all tell you that 99% of their work is making up a way to say no, and 1% is begging those handful of investors to let them invest in their company. But that is not the people listening to this podcast. And I believe that if you've lived this life and you put everything into a startup that spends several years on and then you have to shut it down, I think that is grief, what you go through. I genuinely think it's grief. And I think there is no cure for grief. There is only time.
Hi everyone, welcome to 23 Mile with me, Kayode Odeleye. Today we're joined by James Green, General Partner of DQ Ventures. The venture world sells you a simple story: quit your job, raise tons of capital, build something great, and then get rich. What isn't obvious on social media is that 90% of all startups fail. James learned this the hard way, well, like I did, by the way. After becoming managing director of a creative agency in the UK, he raised $2 million from investors to build a tech startup. Like many others, it failed. That experience led him to co-founding one of the world's few venture investors focused exclusively on experienced professionals. In 2020, James co-founded DQ Ventures with a contrarian thesis that experienced professionals should not quit their jobs when they want to start tech companies. Instead, DQ helps de-risk and devalidate the idea before the founders go full-time. On the show today, we will be discussing why tech entrepreneurship hype is so seductive to everyone, but also to successful professionals. The reality that failure is the default outcome for tech startups, and how founders can mitigate failure, whether they're still employed or already gone full-time. James, welcome to the show.
Thanks, Gary. Nice to see you again.
Yes, I think one of the last times we spoke, it was when I had written an article for DQ about my own experience starting a tech company.
That's right. Yeah, I remember it well.
Yes, that was, time flies. That is almost three to 4 years ago now. And I remember how you titled it, it was Gung propaganda.
Really?
Yes.
Yeah.
Tell us about that term, Gung propaganda. Where did it come from your experience or what you've seen with others?
Well, there's a well-known concept in startup world called survivor bias,
Yes.
and where the only thing that you read about are the huge successes, and nobody really wants to talk or read about the failures. And so those tend to go unnoticed. So the concept or the way it looks to somebody who's not really paying attention is that building a startup must be easy. It's a great way of life. You end up with sports cars and super yachts, and so I'm pretty smart. If they can do it, then surely I can as well. When the reality is quite different. And as many equally smart people would attest, that they also thought that they'd been successful in everything else they'd done, so surely they would be successful in startup world, only to find quite the opposite.
I think this podcast is going to be a difficult one for me because, like every time you and I speak, I say how what you're solving is what I experience. So every single thing you're saying describes me, and I want to butt in and talk more. So I will try. I'll try really hard and let you talk, but where necessary, I will also share my own experiences. Because like you said, the sentiment in the media is if you're at a job, it's not working fine, you're not happy, you should quit. And then just start a business, which many people are going towards tech entrepreneurship. Why do you think this sentiment towards starting a tech startup without it necessarily being technical?
I mean, there's a lot of factors to it, but I think what it boils down to is that there is a belief that starting a tech company is a shortcut to riches, because many of these startups get very valuable very quickly, particularly now. I mean, it's unprecedented that companies are continually breaking the record for fastest company to 100 million ARR with this new wave of AI businesses. But I think what's missed is that the people who are doing that are a handful of people on the planet who have the technical capability to deliver something extraordinary. And if you talk to a venture capital investor, they'll all tell you that 99% of their work is making up a way to say no, and 1% is begging those handful of investors to let them invest in their company. And they're the ones that you read about. But that is not the people listening to this podcast. Those people know who they are, and they already have investors wanting to invest in their company. So for the likes of you and me, unfortunately, that just doesn't exist. And we'd be much better off focusing on the things that we're good at rather than imagining that we could build a tech company, which really we can't.
What you're saying is my experience. So I have two questions. And the first is this. You said you and I cannot build a successful tech startup. I told someone that a few weeks ago, and they told me that is harsh. Let's dive into that. Let's go into a description of the stereotypical 1% that VCs are chasing that end up exiting like the Brex founders last week, who made $1 billion between them at under 30. Let's go into a succinct description. What are these type of founders?
These type of founders have the ability to build something technical that can scale to hundreds of thousands, if not millions of users. So it's not about the idea. It's about the capability to build something extremely robust and to be able to build it in such a way that you adapt as you build. So as you know, Cody, and I know, and pretty much anyone who's out there who's tried to found a tech company or any company really will probably know that the idea that you've got in your head is not the business that you're going to end up running.
Absolutely. Yeah.
You're going to make a load of assumptions incorrectly. And you're going to have to listen to what the audience and customer is telling you, and you're going to have to build what they want, not what you want. And so those people that can build those companies have the ability to not just listen and understand what the customer wants, but then go away and build that and iterate and get through those terrible times where there's no capital, you can't afford to pay anyone. I think 75% of people that apply to DQ Ventures are non-tech founders who want to start a tech company. But they're going to be competing against tech founders who are trying to build the same thing. There's very few ideas out there that no one's trying to build. In fact, the best ideas are the niche ideas that no one else is interested in building. So forget the kind of next social media or next AI. I spoke to a chap yesterday who wants to take a book manuscript, feed it into an AI platform, and it churns out a ready-made hour-and-a-half long feature-length film. And I was like, yeah, great, but how are you going to do that? Like, you don't have any technical capability whatsoever. And the person that can build that is already earning $1 million a year working for one of these giant AI companies that's raised billions of dollars. It's just not feasible. So for me, the advice that I always give is stick to your knitting. Like, what are you good at? Because it's hard enough to build a business of any kind. And you need some kind of competitive advantage. Only you know what your competitive advantage is, but I can almost guarantee you your competitive advantage is not in building a tech startup.
Very interesting. We've mapped out being technical, being very good at writing software, or being at the forefront of AI. What are the other things that make VCs scramble after founders? I term it the founder pedigree. What are those other components of founder pedigree that a lot of us, when we come in from a professional background, we don't know what it is?
I would say that's a bit of a controversial one, the founder pedigree, because some founders love people who've worked in the MAGA companies, and only invest in people who've worked in Facebook or Amazon or one of those big companies. Others only back people who've worked for the large consulting firms. Others only back young founders. Others only back old founders. So everyone's got a slightly different take on the founder. But I think universally, what people invest in is traction, is proof that the founder has identified a strong need and willingness to pay for something, or at least willingness to use something deeply, regularly, in a market that is potentially enormous. So potentially millions of users. But everybody wants to invest in that. And very few founders actually manage to create that traction. I will say, just going back onto the technology, that with the new tech that we've got, the things like Replit, Lovable, and before that, no-code tools to a lesser extent, it is becoming easier and easier for anyone to knock up a technical prototype. And I see that a lot. I see a lot of people come to us who are a marketing person or they're an operations person, but they've built a prototype with Replit, and it kind of does what it's supposed to do, and it's good enough to get it in front of a few users and for people to try it and have a reasonable experience. So in that way, the kind of tech business idea has been democratized. If you can do that and show traction in a market that is potentially enormous, then I would say anyone can build a tech company, because you could theoretically find an investor who believes in that market, sees what you've done, likes you, believes in your ability to hire in the right people, then they might cut you a check, and then you go and find the tech person who can build it and make it scalable. Because a lot of the problem with, I see with these tools like Replit and Lovable, is that the moment that it has to become secure, stable, scalable is where they fall over, and where you need real technical know-how. But money does kind of solve that problem if you can find and hire the right person who also believes in the dream. So it is becoming more democratized, but I also think that it's just, the temptation then is that, especially that I see, is people tend to pursue these consumer-focused problems that they experience personally, rather than focus on business problems that they understand, where there is already a willingness to pay and a budget to pay. The problem with consumers is, as we all know, we don't like paying for apps. When was the last app you paid for?
I wish I could ask that question before I invested my entire net worth into something nobody was willing to pay for. I wish I knew to ask that question, but it's something I've learned from experience, and I now ask a lot of other founders. But interesting point you raised earlier on there around everyone can build a startup because of these easy code tools, as long as you have traction. That is a trick statement, because traction means so many things. I see many founders who think, oh yes, it's validated. There's a survey of 80 people who are willing to start. That is validated. That is traction. What do you see as that gap between what founders consider as traction, especially first-time founders, and what investors see as real traction that they're willing to fall head over heels over to invest?
There's a few elements to it, but I would say real traction is not people telling you that they like your idea. That's probably the opposite of real traction, because that's the default. People are generally quite nice, and they'll tell you what they think will make you happy and will get rid of you. So I would say traction is someone paying for something. Better sign of traction is people paying for something more than once, so that they're willing to buy something repeatedly. Then you've got even better traction is where the cost of acquiring a customer is less than the amount of money that they pay to you. And if they don't churn, if they continue to pay, then even better. And then even better than that is where a customer will buy something from you and then pay more for something else that you offer. And then again, even better than that is where they'll do that and they will refer a friend or another customer in. so that you are growing without having to spend any money on marketing.
I mean, I think that is quite clear in terms of the KPIs to hit before going out to raise investment. I'd like to dig a bit into your own story and see, and unpack how, how you made mistakes. You're speaking from a place of wisdom now. I mean, hard-won wisdom. I want to hear about this. But, so before you became an unemployable 49-year-old, like you described yourself, though you don't look 49, you grew
I'm
up
not
in...
now. I'm 50.
Tell me about growing up. If I get it right, you grew up in Northampton. I mean, it would be good to hear a bit about, early entrepreneurial influences, if there were any.
There were. My stepfather was a businessman, and actually my dad was self-employed. But I wouldn't define him as an entrepreneur. He was an optician and had no intention of working more than 4 days a week for any year of his life. But he did live well because of it. So I guess both of my father figures were entrepreneurs of sorts. But I didn't really aspire to being an entrepreneur. I just hated being employed and hated somebody telling me what to do, and always had. So it kind of became the default. I really, apart from 2.5 years that I spent in my first proper job, I've never actually really been employed. So I don't really speak from experience when it comes to making the transition in middle age from being a working professional to being an entrepreneur. But I do think that there probably aren't many people on the planet who have tried to set up more businesses than I have. I think I've probably set up now. I mean, through DQ Ventures, must be getting on for 30 now. And before that, I personally have probably set up at least 10. So let's say 40 companies that I have started from scratch or tried to start from scratch. If there are people who've done more than that, then they've had a lot of failure, because most people, one of my business partners sold his business for 85 million. It was the first company he ever started.
Wow.
So he's a
right?
far more experienced entrepreneur in some ways, but not in others.
So, tell us about, I'll come to Skilled Networks, which is the tech company that you raised investment for. But before then, are there any of the remarkable, or which are the either failures or successes before you got to starting a tech company?
So I got a job working for a creative agency, which you mentioned in your intro, and through belligerence and arrogance and overconfidence, I became a director after 3 months, having never worked in that industry. Basically, I thought I was good enough, and I told the people who'd hired me that either I need to be running this thing or I'm going to go. And they were very nice, creative people, and they basically said, okay, you can help us run it, and then ultimately become MD. And so I found myself running a company in an industry that I had no experience in and didn't know that much about. And there is a good, strong connection between that and what I do now, because that's a really hard place to operate from. You don't have any contacts. You don't have any clients, existing clients. You don't really have that much credibility. You don't know how the industry works. You don't know how you go about winning a really big customer and what's required. So we struggled to grow. We were a regional agency and we wanted to get into London. I moved to London and we were trying to win big accounts, but we just didn't know the rules of the game. And I specifically did not know the rules of the game. And I thought to myself, I'm an idiot. What I should have done is gone and worked for a big agency, worked out how they do it, and then go and set up on my own, and maybe take 1 or 2 clients with me, and I'll be off to a running start. And I really believe that now when we're starting companies with entrepreneurs or wannabe entrepreneurs. I try to discourage people from leaving behind all of that knowledge and expertise that they've built over their career to go and do something completely different. Leverage the experience, the network, the contacts, the reputation that you have already, and do something that you find interesting, solve a problem that you really understand, ideally in a tiny niche that no one else is going after and that no one else can do as well as you can, and win in that niche first and then expand into adjacent niches. And ultimately, the sky's the limit. Maybe you build a very generic big business, but that started with a small wedge.
Amazing. I mean, I love the confidence, and I'm sure that has served you well over the years. But how did you go from, moving from Northampton to London? How did you end up in Singapore?
I married I hadn't yet married, but I started dating a Swedish woman who's now my wife and the mother of our children. And she was in insurance, and we were both living in London. I was working from home, and I had my own clients. I could really work from anywhere. And we were going to move out to the Cotswolds in rural England, and actually put an offer in on a house together. And the same week that offer was rejected, Anna was offered a job in Singapore with a very attractive package, and we had no children at that point, and we were free to do whatever we wanted, and we just thought, yeah, let's go. And I think had it not been for COVID, we'd probably still be there.
I mean, so going from running your own, continuing to run the agency in Singapore, you eventually started Skilled Networks there. How did that come about?
So when I sold out of the agency, I effectively went freelance and then teamed up with three friends and built another small agency. But I also, on the side, was doing some work with a friend of mine from very early on in my career, who was a technical guy, very experienced, incredibly intelligent technical guy. And he knew that I liked entrepreneurship and I wanted to invest some of the money that I'd made into startups. And he wanted to do the same. So we teamed up and we pooled our capital and we basically created a business called Medra Capital. And the capital was mostly his, I might add, because together we had delivered a big technical project for IKEA. But it was a business that he set up, and I just came in right at the end to try and win some more clients. But we took some of the profits from that exercise, put it into this business called Medra Capital, and started investing in startups. Got to know each other well, made a few mistakes, and had a few successes together. And then we thought, we seem to be reasonably good at investing in startups. Why don't we do our own? I'm kind of a sales guy. He's definitely a techie. And we did exactly what you shouldn't do. And we locked ourselves in a room and made a list of ideas that we thought were good, picked one, and then raised capital and went and tried to do it, which I now know is not the best way to do things.
Are there any successes from the investment, from the $1.5 million or so you invested in Medra Capital?
Do you know what? At one point, it looked fairly certain that we were going to make 3 times our money. And that was dependent on one business in particular that was doing extremely well. They were doing between 5 and 10 million recurring revenue. They'd moved to the US and they were borderline profitable. And it looked like a success story. And it was in a quite an acquisitive space. And there were some people that looked like they'd be an obvious buyer. As can happen, we got an email as investors. All the investors got an email saying, "We've discovered a hole in our finances. We're about to run out of money. We have no options but to do a fire sale, and no one's going to make anything." So that was quite a painful lesson. So we made enough back to cover our costs, but not much more. I suspect when everything filters through, we'll probably make a bit, but it definitely wasn't worth it. And honestly, outside that, I've done about 65 direct investments myself, and I would say the same. I would have made much more money by investing in something much more safe. I have a running joke with a friend of mine because, at least for me, it was an education because I'm still in that world, so I can consider it money well spent in a way, because it's what's sort of led to DQ Ventures. But for him, he's a businessman and he doesn't do anything in startups. So it's just money that he didn't make, unfortunately, in his case.
I mean, we could dig into that whole, the startup that was doing well, holding finances, financial literacy. It's something I've spent so many years talking about, but it's also a big problem with startups. Maybe we'll come back to this towards the end. But with Skilled Networks, you and your partner looked at these ideas, picked one, and you went on to raise almost $3 million. Was that straight out the gate, or did how much work, how much traction did you have before you raised the money for this idea?
I mean, very little, ultimately, and there's no way you could do that today. So this was in 2015.
Okay.
The world was very different then. Everybody was throwing money into startups. We raised $840,000. That was Singapore dollars. So what's that? Probably $500,000 US with a deck and nothing else to start with. And that was from friends and family. We had a reasonable network, but we weren't venture capital people. We wanted to be, or we thought we wanted to be. But I couldn't do that now. And I'd still do sometimes raise capital, but it's a completely different world now. By and large, people lose more money than they make, and so that capital now doesn't exist. So I'm one of them. I don't know how much money I've invested in startups, but it's a decent proportion of my net worth, and most of that is still locked up on someone's balance sheet. And so any founder starting now just doesn't have that pool of capital, and this isn't talked about enough. So it's a very different world to try and start a company funded by someone else's money.
Very interesting. You've referred to that success of you've talked about the investors losing their money, but you've also referred to that quote unquote success of raising so much money so quickly as false validation. Why is this so?
Because all it validates is that someone believes you, and you probably believe yourself. And if you've been able to raise money, hopefully you do believe yourself. Otherwise, you're not a very nice person raising money for something you don't believe in. But the only real validation is that a customer will pay for something. And there are companies who raise way more than us who still don't have any validation. They just know they have a bigger idea, better network. They've raised tens of millions. I was speaking to a chap yesterday that one of his friends had raised, I think he said they've raised $33 million, and that business valuation was 100 million.
Wow.
But he said, realistically, I reckon that business is worth 3 million at most. Because it's not a business, it's just a fundraising machine. And there's a lot of that out there. And it's easy to get, as an investor, especially if you're relatively new to it, it's easy to get caught up in that and to imagine the $1 billion exit and drinking champagne on a boat somewhere, but generally it's not the reality.
And how did this pan out after raising this money? Talk me through what happened next. How, what did you achieve with it? How far did you go before things ground to a halt?
So we did. I don't know if my co-founder would agree with me, but I think we did the wrong thing. That we raised a lot of money, we built a tech team, and we built a pretty good product. But we really struggled to sell. The idea was a marketplace connecting temporary workers to hourly paid positions. So it could be cleaners, bar staff, drivers, waiters, you name it. And there were two things that we got wrong. One is that we totally underestimated how competitive it is. And we also got a bit unlucky. Some very big and well-funded competitors sprung up in the same market, and we launched in London. So pretty much every door we knocked on had already been knocked on by someone with a very big sales team. But actually, I think we could have probably overcome that. But what we failed to overcome was we didn't understand the market. Like, we weren't recruitment people. And when we spoke to recruiters after the fact, many of them told us that I could have told you that would happen. So we didn't know the market well enough. We didn't speak to enough people. We didn't take doubters seriously enough. We thought we knew better. We thought we were smarter. But ultimately, the big problem was that we had an application that could very elegantly match workers and work shifts and everything around it, the payroll and everything connected with it, the right to work checks. It was a very elegant solution. My partner's a very clever man. But it didn't matter because when people accepted shifts, they would only turn up 30% of the time. And so our clients were left thinking that John Smith was turning up to drive his lorry, and then John Smith didn't turn up, and they'd get on the phone to us. And basically we ended up being like a recruitment company, not like a technology company. We were just trying to find the replacement for John Smith, who didn't take the app seriously. And the truth is that we thought we were Uber for workers, but the workers didn't think we were Uber. They didn't need us. They had many other recruitment agencies that they could go to and find a shift, and they just didn't care. So it was just too hard.
So what I hear is, in this space now, the companies were probably happy to pay, but from your point of view, you did not really understand the dynamics of the space enough, right? And like you said, there was competition, and you also didn't have, you couldn't sell effectively enough. Knowing what you know now, would you have started the same idea in that same space at the same time and done something different, or you will just not have gone down that path at all?
I definitely would have tackled that idea. And as an angel investor and as DQ Ventures, I've been pitched that idea about 5 times subsequently. And I think I've been the perfect person for those people to pitch to, because I've done my best to talk them out of it, or at least to explain the problems they're going to have. No, I would never have done that. I would have launched a business that I was the expert in, and that I knew the intricacies of the problems. I knew the difficulties we were going to have, and I believed that I could get around them. The problem with us was we didn't know the unknown unknowns. Or I should say, the problem was the unknown unknowns. At least in a business you understand from top to bottom, you know what the unknowns are. And there aren't many unknown unknowns. And so you've got a much better chance of succeeding.
Very interesting. And did you go through any pivots before you ended up shutting down, or was it pretty obvious this was going nowhere?
I think one thing we did well is shut down pretty quickly. Nice, okay. We did raise 3 times, and we tried to pivot. We shut down in 2017, right during the peak of the ICO boom, and we spoke to our investors, and the majority of our investors said, "Look, don't shut down. Just try whatever you think you can do. If you shut down, we've already lost our money. If you can, turn it into something different, then there's still a chance." So we tried, but unfortunately, we tried to launch our own token. Right, I think it was June. Maybe it was June 2017, or whenever it was right when the whole ICO market just popped. And so we had no chance for that either. So then we shut down, and I had no corporate job to bounce back into. So I just bounced around trying to find work. A friend of mine, fortunately, ran a startup and thought I had some value and gave me a job that paid our bills. But definitely was not a very nice time, not a nice period of my life.
I mean, like you said at the beginning, nobody talks about this outcome. I mean, you're in your 40s, you're well experienced, you've earned a lot in the past, and then you didn't beat failure. It's a really dark time, and not a lot of people talk about it. But what are some of the things that saw you through that 18-month period?
I mean, what saw me through it? The fact that I had a young family meant that it wasn't all bad, but there was also the necessity to be able to pay our bills. So it's like you don't have any option. I didn't have a large nest egg. Having always been an entrepreneur, I hadn't put a lot of money away. So just did what we had to do. I was talking to another founder about this actually recently, he's going through it now, having just shut a company down. And I believe that if you live this life and you put everything into a startup that spends several years on, and then you have to shut it down, I think that is grief, that what you go
Yes,
through. I
absolutely.
genuinely think it's grief. And I think there is no cure for grief. There is only time. And so you have to let yourself grieve, and you cry your tears, you have your sleepless nights, you get up at 3 in the morning and go for a run because you can't think of anything else to do. And ultimately, one day you realize that you feel a bit better. And then for me, I genuinely think, not that I would want to relive it, but it's got me to where I am now, and it has been a positive influence in my life. But at the time, it was. I mean, it's definitely also the worst thing I've ever had to experience.
I mean, I know that feeling. At the deepest point for me, I was like, I'm done. I'm going back to banking. But for you, you didn't even have, say, like a corporate career to say, you know what, I'll go back to it. So what were the kind of options you were thinking of during this 18-month period?
Yeah, I genuinely think that it's not a bad idea to have a corporate career before you build a startup, because you do need something to fall back onto. Unless you get lucky the first time round, that you probably are going to fail, and it's good to be able to make some money when you fail and rebuild your finances.
I mean, I'm talking about corporate careers. If I get the description right, what you're doing now is building, over the past 6 years, the world's first venture investor focused exclusively on professionals. How did you come up with this idea and launch with your co-founders?
So it was a very organic way of coming up with an idea, because I was after shutting down my startup, I got that job, and I was giving a lot of advice to people who were in that very early phase, and it was always advice for free. People would ask me to meet, and then I got a bit of a reputation as being a good person to give advice. So meeting after meeting, I would be giving people advice on what to do, what not to do, how to avoid the mistakes I'd made, and I was moaning to a friend of mine about that. I was like, I really need an income, and I'm giving a lot of value to people. I'm literally, sometimes I'm sure that I save people from failing. I gave, there's a couple of founders I remember. I spoke to them for about 15 minutes, and they totally changed their business model and ended up exiting their company, and didn't make a killing, but they probably made between 500,000 and 1 million each. And I'm pretty confident they wouldn't have done that had we not had that meeting. They were definitely going in a very bad direction. I did a lot of that, but I didn't make any money, and I really needed to. So I was saying to my friend Arjun, I don't know what to do here. How do I monetize this advice? Because I know there's value in it, but we couldn't think of a way. And then at the same time, I was saying, and the other thing is, on the investing side, the only money I'm making is from 40-year-old founders. It's not from the 20-year-olds. They're all just flaming out or giving up or going traveling or falling in love. But it's the 40-year-olds who are doing something a little bit more boring. They knew exactly what they're going to do, and they just go and do it, and then they make you 3 to 6x on your money. And I was like, I'd rather have more of them, but where do you find them? Because 40-year-olds don't start startups. Their life is too good. Their responsibilities are too onerous, and it's just not a good bet. It's too risky. And then I think between Arjun and me originally, and then Oliver shortly afterwards, we said, hang on a minute, there's an absolute no-brainer idea here. We find these mid-career professionals who really want to start a business. We leverage all the stuff that we know to actually help them get started, and we do the work, because we don't need to do a job. So we can actually work in the startup, keep them in their job. They can pay us a little bit of money, so because they're the ones who are earning the income, and we can earn a bit of equity in the business. And then once we get through that really tricky 0 to 1 bit, they can come in, take over, and we can go on to the next one. And so literally the three of us just started doing that, and just trying to find people to help and bring their business to life. And it's kind of spiraled from there.
At what point did that go from that phase to, okay, this is a fund now, this is something?
I would say it probably took us about a year, I think, of just doing it. We were doing it without having a company for a start, and then we incorporated DQ in the middle of 2020. So we already had our first company by then. And And then I think we probably raised money 6 months after that. So we just did a friends and family round to bring a little bit of capital in. We were actually investing cash in the first few founders. We thought that was the model. Where I'm indirectly I'm an investor in Antler, so I knew what their model was, and I thought, oh, that's quite clever. You invest some money and you take some of it back as fees. But actually, we did that for a while, and then we just felt like it really wasn't nice. It just felt a little bit like cheating. Like I'm going to invest 100 grand in you, but actually I'm going to have 40 grand back, so it's only 60. And we just thought, let's just not do that. Let's forget the cash investment, and we'll just invest the value for nothing, and we'll fund it. So we needed to pay the costs of the business, for which we raised the money.
Okay, I mean, you've kind of described the whole origin story. Maybe let's also then just in a few words, what is DQ Ventures? Let's define it. Let's tell the listeners, what is DQ Ventures?
So we're not a fund. We're not structured like a fund. We're a business, and we consider ourselves a business builder. So we're not an accelerator. We're not an incubator. I do think we've invented something new. I don't think what we do exists outside of DQ, which is we are effectively hands-on co-founders for the first 12 months of the business, who very much direct and lead the founder through a best practice way of starting their company, so that they avoid the obvious pitfalls of product first, too much building, not enough selling, not enough validation. And so we direct people towards a route that we think offers the least possible risk of failure. And it's all about finding the first customer, then building a solution that can scale to more than one customer, with some tech usually, or some automation, and then developing a go-to-market sales process that can deliver repeatable sales. So ultimately, what our founders want is a business that they can deliver outside just themselves. We don't want a load of freelancers. They need to be able to deliver something that doesn't involve just them spending time. And they also need a way of getting more customers. So then they've got a business that actually can scale. And once we've done that, we think, right, our job here is mostly done. Now we'll retire to an advisor position and a minority shareholder position. We keep 20% stake in the business, and then we sit not as board members. We're not officially on the board, but because these companies don't tend to have a board, especially very early on. But we have a regular catch up. We're what you'd probably consider board observers or board advisors, and then we continue to make referrals. We try to cross-pollinate both deals and advice between our startups, and then all the way through to if they want to exit at some point, then we'll be there to help guide them through the exit. Because between us, we've had quite a few exits of our own companies and of companies we've invested in. So the idea is that we're kind of like the right-hand man all the way through from start to finish.
Nice. I'll come back to the exit point. But somewhere I think I saw one of your posts where you talked about going through 750 applications from founders last year, and of which you select a few. So what I get from that is DQ is a selective partner. You don't back just anyone. Tell me or describe to me, what is the perfect founder or founding team that you like to partner with?
So we do have a pretty clear criteria for what we look for. So we want people who are some kind of expert in what they're doing. They have something that gives them a competitive advantage. They have to be motivated for the right reasons, which has to be some kind of purpose or passion, and not what we call the vices, which is fame, wealth, popularity. So we don't want people who are just doing it for the ego, because as you know, Kyodo, that when you're starting a company, when you're running a company, you're going to go through some pretty terrible times.
Absolutely, yeah.
And if you don't have something driving you that is more than just a desire to make money, then you're almost certainly going to quit.
Absolutely.
So the worst thing that can happen to us is that we start a company, it goes well for 3 years, then it goes through a rough patch, and the founder's like, do you know what? This isn't what I want to do with my life. I'm going to go back to banking. We need somebody who's going to battle through, pivot if necessary, and get through those tough times. So it has to be purpose-driven. We want people who are coachable, who will listen, because nobody knows everything, and they have to be willing to be flexible and sometimes change direction. Almost always there's a need to pivot. Pivot's not a nice word, but you need to flex somehow and be flexible. So all sorts really. And we also, one of our 4 company values is only to work with good people. Nice. We're all old enough and ugly enough now that we don't need to work with who we don't want to work with. And so if somebody comes across as a bit of an egomaniac or just someone you don't want to go for a beer with, then we'll just agree internally that it's a good idea and it's got legs, but we don't want to work with that person.
Very, very interesting. I think you mentioned you have about 10 investments over the past 5 years. What's the age range of founders? Age range and also years of professional experience.
So one of our selection criteria is that someone has to be working for 10 years. So it's not a huge amount, but it's just we had to draw the line somewhere, and it just seemed like an easy one. We have had younger founders who we've worked with to some extent, but I think our youngest founder is probably 30. I don't think we've got anyone in their 20s. And we've worked with people who are almost 60. So there are statistics out there that will show you that a 60-year-old is more likely to succeed than a 50-year-old, who's more likely to succeed than a 40-year-old. And the average age of a successful startup founder is 45, according to MIT.
I like that stat because I'll be 45 this year.
Okay, perfect.
And an unfair question, so feel free not to answer. But of all your investments, either at DQ or before that, do you have any favorites?
Honestly, DQ is my favorite. I've invested a lot in DQ in every way, but I believe that it's the one business that I am involved in that is genuinely bringing value to almost everyone it touches, has huge capacity to grow, and is filling a gap and helping people who really need help, who don't really have anyone else helping them. But from an investor point of view, I've got so many that it's hard to think of one. Indirectly, as I said, I'm an investor in Antler, which is probably the one that's done the best, on paper at least. But there's a few. There's a social media app called How About, which is doing really well. I just invested in that through a crowdfunding platform. But for me, honestly, one of my favorite investments was a business called Tailster. I made no money. It failed. But I made a really good friend in the founder. We've helped each other. He's helped one of our portfolio companies to transform their business by changing their business model. So it's not just about the financial success for me. It's been about the people. And I've met some amazing founders who have become a really important part of my community and network. So that's probably been the real upside.
It's all about people, right? So, I definitely share that. And then, the success of any investor like yourself, because at the end of the day, you retain a stake in the companies. It's all about the exits. How do you see the exit space right now? And is there anything you do as DQ to help founders on their path to achieving successful exits?
There is, because we are removed from the business somewhat, then we are probably in a better position to think about exits than our founders. Having said that, we're not just focused on exits. So we are focused on liquidity.
Okay.
But like, for example, the first company that we helped to start is a recruitment company, which is doing very well, should issue its first dividend this year.
Amazing.
And so we're happy to collect dividends. Anything that we collect that delivers cash flow to our shareholders, which is us and the people that invested in us, we see this as an evergreen business that's just going to keep going, keep spitting out portfolio companies, and keep generating cash flow from either dividends or exits. But that's starting from probably another 4 years from now. You're probably not going to get much liquidity until 10 years after beginning. But after that, then it's a bit of a conveyor belt in a way. Not that I want it to sound like a factory, because it's definitely not. It's very personal. But at the same time, this is a business that should be able to last forever, rather than just be something that you build and sell and hope that the acquirer doesn't mess it up. But yeah, as far as our founders are concerned, most of them come to us thinking they're going to sell. And it's been quite interesting seeing how their point of view has changed once the business starts generating cash. And they're like, actually, do you know what? This is a pretty good life. I'm making more money than I've ever made. I'm the boss. And I don't have to work too hard. I can go on holiday whenever I want. I've got a team that delivers. I don't necessarily need to stop. Which has been a bit of a surprise, because it almost universally people are like, I'm going to do this for 5 years and then sell it. But I'm sure there will be people who want to sell, and then I think we're pretty well positioned to with our network to help them exit.
I mean, I think it's probably worth emphasizing that point that as against what most VCs are building to sell, building to exit, building to IPO. What I hear from you is, you're focusing on all the professionals, you're helping them de-risk, and you're helping them build successful businesses. That's what I'm hearing as the primary focus, right?
Yeah. And then we're helping them build successful businesses that are going to give them optionality for an outcome that they want. And the way that the business is structured is the founder contributes something at the start, so there is a bit of a cost to them. But once that is done, then DQ Ventures gets nothing out of that business until the founder does. We have the same shares they have, so we don't earn any money until they can earn a salary before we do. But when it comes to actual dividends or exit proceeds, we get nothing until they do. So we're 100% aligned with the founder. We are absolutely motivated to give them the outcome that they desire. And at the same time, we want to give our shareholders liquidity. So our shareholders are private individuals. We have one VC actually, so he wants us to sell. But at the same time, we're getting to the point now where I had a conversation with a family office last week where they like the fact that this is an evergreen model. The business is self-sustaining, more or less. It should be self-sustaining by middle of the year, hopefully. And then it's just a way to just continually build value. And for family offices who are in it for the long term, then that's potentially quite attractive. So hopefully we can give our VC investor their exit by someone else buying in, who's in it for the long term.
Amazing. Thanks so much. I have just a few quick fire questions for you before we round up. The first one is this. I mean, with, I don't know, maybe almost 30 years in entrepreneurship, what's one word that to you captures the spirit of entrepreneurship?
Ooh, that's a tough one. Well, I think autonomy, probably.
I like that. Okay, I like that. Awesome. And I can see how that is a very valuable, part of being an entrepreneur. The next one, should founders raise from friends and family, or should they skip it?
If you can avoid it, then don't raise from anyone, because the moment you accept capital from someone else, then you have a responsibility to pay that back, whether you like it or not. If you are a decent person, you're going to want to return that money, especially if it's friends and family. Okay. So if I would do it all again, I think I would only take debt, because the money that I've raised, I feel like I need to pay it back anyway.
Yes.
So it's the fact that it's equity and that there's a contract that says how that works doesn't really matter to me. It's like, these people gave me money, I've done something with it, I need to return that money. And that's true for the people that invested in me when I failed as well. I feel like I owe those people.
I know that feeling. I definitely owe the angels, the individuals who invested in me. I feel I owe them forever, but we'll see.
Yeah.
Anyway,
It's a
so
tough
if
one.
you had to choose either for your portfolio companies or if you're doing something else ever again, and you had to choose between bootstrapping or raising VC, which will you choose?
Well, it depends. I mean, I definitely bootstrapping is the obvious answer. That's everything I believe in. But at the same time, I do believe that VC exists for a reason. And without venture capital, then we wouldn't have the step changes in technology that we are getting.
I mean, I think this is a very good point to close because you've talked about how venture capital is very selective for founders. If you fit the bill, if you can build something great, if you understand what it really takes. Because one thing I fell for was I saw venture capital as this merit, this merit-driven area where anyone could come with a big, great idea and be funded. It's not so at all. So, I mean, I think we can end on this. But any other party notes? Any other words you like founders to know about this wonderful autonomous journey?
I don't think so. I think we've summed it up. I would just say that don't assume that because you're smart that you can do it. It's got nothing to do with how capable you are. It's a real mixture of knowing the problem that you're solving and luck, and also ability to keep going. I mean, really, I'm 50 and for me, in a way, I've kept going because I had no other option. But if I end up with making millions of dollars and having a super yacht, then it would look inevitable. It'll be like, yeah, that guy made all the right moves. He stuck with it. What a champion. But actually, if luck goes the wrong way and it doesn't work out like that, then I would have had a terrible kind of financial experience. I don't have a pension. I don't have the money in the bank that my banker, lawyer, corporate friends have. So it's a massive decision and sacrifice that you make to build your own company. And I think you got to think really hard about when you do it, how you do it, making sure that you've got optionality and you're not just all in too early.
Thank you so much, James. Thanks for joining me. On that note, we've come to the end of today's podcast. Thank you so much.
Thanks, Kelly.